Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mtr Corporation Limited, latest report. Mtr Corporation Limited offers a wide range of businesses and services across various sectors. In the transportation sector, it operates passenger rail services on domestic mass transit railway systems, airport express, cross-boundary railways, light rails, and bus feeder services with railway systems. It also provides intercity railway transport. In addition to transportation services, Mtr Corporation Limited offers commercial activities such as letting advertising, retail, and car parking spaces at railway stations. The company also provides mobile and fixed telecommunication, bandwidth, and data center services in railway premises. Furthermore, it offers property management, development, and rental services through its property division. The company's other businesses include construction, operation, and maintenance of mass transit railway systems, financing, investment in technologies, and cable car operation. Mtr Corporation Limited also provides training and consultancy services through the Mtr Academy, which develops railway engineering and management professionals. The company offers Octopus, a contactless smart card common payment system for convenient transactions. Overall, Mtr Corporation Limited's diverse range of businesses and services makes it a significant player in the transportation and property sectors. The significant increase of over 37.77% in Mtr Corporation's stock price in the past year can be attributed to several key news events and corporate developments. The company's strong financial results, particularly its net profit of approximately $15.8 billion for 2024, driven by one-off property development bookings, contributed to a 33.65% rise in the stock price following the announcement. The subsequent announcements of Mtr Corporation's 2025 interim results and the securing of a record $30 billion green loan further boosted investor confidence. The company's net profit attributable to shareholders surged by 27.5% to $7.709 billion in the first half of 2025, largely due to a substantial increase in property development profits. Additionally, Mtr Corporation's strategic expansions in railway services and property development, such as the introduction of new direct destinations on its high-speed rail, Hong Kong section, and the upgrading of the Shanghai-Hanqiao sleeper train service, further strengthened connectivity between Hong Kong and mainland China. The company's positive corporate governance updates, including the update of its board and executive directorate, also contributed to the increase in stock price. Overall, these events collectively contributed to the substantial increase in Mtr Corporation's stock price during the past year, reflecting investor confidence in the company's strong financial performance and strategic developments. Mtr Corporation Limited market capitalization of $215 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Mtr Corporation Limited holds a significant advantage in their industry. Mtr Corporation Limited trades at a higher price-to-earnings ratio of 12 times and a higher price-to-book ratio of 1.15 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.79%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified in two main categories: Hong Kong transport operations, and Hong Kong property development. In the former, revenue growth is attributed to increased patronage from high-speed rail and cross-boundary services, higher revenue from Hong Kong railway services, and growth in the SOUTHSIDE packages. On the other hand, revenue decline can be seen in the decrease of profit from recurrent businesses, loss from fair value measurement of investment properties, and a 19% decline in revenue from Chinese mainland and international railway, property rental and management subsidiaries. In terms of specific drivers, Hong Kong transport operations have experienced growth due to increased patronage and higher revenue. However, this growth is offset by increased funding requirements for network expansion programs. On the other hand, revenue decline can be attributed to a range of factors, including decreased profit from recurrent businesses, loss from fair value measurement of investment properties, and reduced project revenue from Melbourne operations. The Hong Kong property development sector has also experienced growth due to progress made on several property projects and an increase in specified non-current assets. However, this growth is not uniform across all sectors, with a 19% decline in revenue from Chinese mainland and international railway, property rental and management subsidiaries. The handover of operations for the UK Elizabeth Line and decreased revenue from Sweden following concession termination have also contributed to revenue decline. Overall, the primary drivers of revenue growth or decline are complex and multifaceted, reflecting both internal factors such as increased patronage and higher revenue, as well as external factors such as changes in market conditions and regulatory requirements. The company's financial performance indicates a strong ability to generate cash from its core operations. The data shows that the company has consistently produced positive operating cash flow in recent years. In 2025, the net cash generated from operating activities was $11,874 million, while in 2024 it reached $491 million. These figures demonstrate a stable and healthy financial position for the company, allowing it to invest in its business and meet its obligations without relying on external financing. Management is optimistic about the company's outlook, citing several key factors that will drive growth. The company's transport operations in Hong Kong are expected to continue growing due to increased patronage, and profits from railway project investments will fuel further expansion. A healthier operating environment is anticipated, with progress in major railway expansion projects and a focus on managing capital expenditures while maintaining financial prudence. This will enable the company to tender new projects in the coming 12 months and capitalize on declining interest rates. The company's strategy involves investing in Hong Kong's railway projects through the R+P model, which will provide a steady stream of revenue. New station packages are also expected to be tendered, further boosting growth. Management is confident about the future, with a strong outlook for targeted completion dates on major railway projects. The company is proactively exploring financing approaches to support its forward-looking capital expenditure needs and welcomes government approval for new initiatives. Overall, management's strategy is centered around diversifying funding sources, managing capital expenditures, and investing in Hong Kong's railway growth story. This approach will enable the company to maintain a strong financial position while driving growth and expansion over the next few years. The company has a history of paying dividends to its shareholders. In 2025, an interim ordinary dividend of HK$0.42 per share was paid out. Furthermore, the board of directors has proposed a final ordinary dividend of HK$0.89 per share for the same year. This payment is scheduled to take place on June 22, 2026, indicating that the company's commitment to rewarding its shareholders through dividends remains strong. Concerns about inventory buildup and supply chain disruption are present in the company's operations. One area of concern is the potential for supply chain disruption due to payments to creditors following the handover of operations for the UK Elizabeth Line in 2025. This could lead to delays or disruptions in the delivery of goods and services. Additionally, there is also a concern about inventory buildup, specifically with regards to property development projects. The company has invested $896 million in ongoing property developments, primarily for the Oyster Bay project. While this investment may have long-term benefits, it could also lead to inventory buildup if not managed properly, tying up capital and resources that could be used elsewhere. That concludes the financial summary for Mtr Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.